All right, so let's straight away get to it and analyze some of the most important takeaways that impact your life and my life. Yes, we're talking the personal finance aspects and, of course, the personal taxation aspects. Joining me, Surabhi Upadhyay, are Ashish Shankar of Motilal Oswal Private Wealth Management, as well as Preeti Khurana, who's the expert at ClearTax. Thank you very much, lady and gentlemen, for joining into this digital conversation. Now, Preeti, I think we'll get her in the next couple of seconds. But Ashish, before we get down to the finer points, your takeaways. First of all, I'm relieved, at least for me, there doesn't seem to be any immediate increase in income tax, no changes in the slabs. And I don't think there's any change in that health and education cess as well. So you tell us your biggest headline.
Yes, absolutely. I think it's a relief that there is no major changes to personal taxation. Albeit, I think fuel is going to go up. It's going to become more expensive. Petrol and diesel, they've levied an agricultural cess. So that's an increase for the personal taxpayers. Other than that, I think it's a good budget because they're focused on growth. The deficits will go up. I don't think people will mind the higher deficit this year because if you look at India as one of the countries in the global economy, most global economies are going to have higher fiscal deficit this year. So on the whole, I would say it was a good budget, and they've kept it simple.
Okay, let me see if Preeti can hear me. Preeti, hi. Are you in the conversation?
Yes, I can hear you.
Okay, I don't think we have her joining in just yet. So let's just.
I can hear her, Surabhi.
Okay, yeah, I think then I'm having a slight trouble with my connection. So Preeti, your first takeaway as well on what you thought overall.
Yeah, I think I agree with both of you when you say that luckily there have been no increase in tax rates. I think that we were all worried about, especially, as all the spends that they want to do in terms of increasing health infrastructure and whatever else they were saying, in terms of vaccination costs and all of that. So I was slightly concerned about increase in surcharge or cess, but it's actually good news that they've not done the usual left pocket to right pocket where they take money from a few people to give tax relief to others. They're focused on compliance. I think that's a bigger aspect. Whenever you ease compliance, whenever you make things easier for people to do their taxes, compliance always goes up. People become more compliant and tax revenues also go up in that sense. So, of course, we need to look at the fine print, but largely speaking, definitely, this is, it's like a feel-good budget because there is no raise in tax rates.
I think there could be a slight connectivity issue. Okay, Ashish, can you hear me?
Yes, I can hear you very clearly, Surabhi.
Okay, so I can hear and talk to Ashish, but I don't seem to be connecting with Preeti, so that could be a problem. We'll try and add her back to the conversation. So Ashish, apart from the fuel bit that you spoke of, what else stood out for you? I think from an investor standpoint, I did notice in the next years, there's a very important change in the way ULIPs are going to be treated. So tell us more.
Yes, so ULIPs had the 10D exemption, which meant that whatever money came out of ULIPs was tax-free. And there was, a kind of an anomaly with mutual funds because any mutual funds units that you invest in and redeem is subject to capital gains. So they plugged, that differentiation between a ULIP and a mutual fund. In a sense, I think it's good for the mutual fund industry that there is parity with ULIPs. As a lot of investors were preferring ULIPs over mutual funds because of the tax. Although I have always believed that both products have to be looked at very differently, and insurance should be treated, invested more for protection. But they've just plugged that gap, to the MF industry.
Okay. Finally, yes, I can see Preeti and I can hear her as well, I think now. So Preeti, you give us your first inputs. First of all, is there anything in those annexures that we've not still gone over? Any googly out there?
Yeah, I think whatever is there. So, whatever time I could get, I actually looked at the tax rates. So, for sure, there is no change in tax rates for the old regime or the new regime. There is no change in surcharge. So that's all in green. No changes there. What I came across was that there is some offering in terms of LTA. So those who have LTA balances and they want to go ahead and claim, there is a certain exemption which has been provided, and I saw rupees 30,000 number there. Besides that, I also looked at, there is a certain cap on how much interest income you can earn from your contributions made to PF. So there's a maximum cap on that which has been brought
Yeah.
in, these 2.5 lakhs. Other than that, couple of things.
So just Preeti, one step at a time. This cap on the contribution to the PF, this is very important because this had stirred up a lot of emotions even last year. And I remember that for the super rich, there was a cap of 7.5 lakhs that was introduced. And I
That's
think
right.
was it the employer's contribution? I think the employer's contribution had been capped. So what is the 2.5 lakh rupee cap this time?
So last time around, they had brought in a maximum cap on what your employer can contribute towards your EPF, towards your NPS, and also your superannuation. So they had said for all high income earners, if your employer is contributing more than 7.5 lakhs, then whatever is the excess will become taxable for you. So now what they're saying is the interest that you earn on your PF and other contributions, if that exceeds rupees 2.5 lakhs in one financial year, then the excess could become taxable for you. So
okay, so not the contribution. That's an important point. So it is a hit, but not as big as perhaps what initially sort of appeared. So it's the interest that you earn in the PF. On that, there is a cap. So above 2.5 lakhs, you'll have to pay tax. But the contribution has not been capped. There's no change there. So no matter how much you're contributing as an employee, that contribution is still allowed. That would be right.
Absolutely. So as an employee, you can make contributions to your EPF via the voluntary PF route, and you can do contributions to NPS, which earns you an additional tax benefit, by the way, under Section 80 CCD 1B. Then you can do a 50,000. You can do even more than that. But now they understood this game. So, sort of like instead of employees going through the employer route, which was actually far more tax efficient, and they covered it last year. Now what they're trying to do is make sure, because paying that kind of 8.5% interest on your PF is completely unsustainable for the government. And from all the angles, they just want to make sure that this is not something that you're earning absolutely tax-free income from, neither at the time of accrual of interest nor at the time of withdrawal. So you don't pay any taxes, and therefore there is only so much that you can earn as interest income on the deposits made to your PF account. So yeah, interest is actually calculated. If you look at your PF statement, you will see that it has entries, which appear at the end of the financial year, and that's the number that you need to be looking at, because so it's actually a cumulative effect of all your deposits. So every year and every month you make deposits, your employer makes a deposit, and at the end of the year you get interest on the entire deposit. So now you need to make sure that it stays within that 2.5 lakh limit.
So in a sense, the whole idea that a lot of people were looking out for, where PF was obviously far more tax efficient than, let's say, keeping your money in a fixed deposit, that whole idea goes out of the window, because now you only have the 2.5 lakh limit. Above that, whatever interest you're earning, sure, it's higher in the EPF, for instance, the interest has always been high, about 8%. So the interest will be taxed above 2.5%. So in that sense, the charm of moving your money from a fixed deposit and keeping it in the EPF, that goes away, Preeti?
So exactly. So what had started happening was, and the government gave some data around it last year, was that those who were 50 years or older, they were increasing their basic salary to a great extent. So a large part of their package was basic salary, because that's the number on which your PF contributions get calculated. So by increasing your basic salary, you could enhance the amount of contribution that was getting transferred to your PF account. And once they capped it at 7.5 lakhs, your total aggregate contribution, now they've also put a cap on your interest that you can accumulate on that. So I think that's a tough one for high income earners, like really high income earners, especially those who are now nearing retirement. For them, it's going to be a challenge.
Okay, so watch out for that. Well, at least the high income earners can take heart from the fact that there is no super rich tax or a new wealth tax or an increase in the surcharge rates, right, Ashish? What do you have to say? I mean, in terms of just offering solutions to the super rich, your ultra HNI clients, I mean, is this going to be a part of conversation?
So I think not really. I mean, the good part is, like you said, there is no surcharge for ultra HNIs, so which is a good thing. I also see that they have removed the deduction of TDS on dividends from
Right.
REITs.
REITs and InVEITs, yeah.
REITs and InvITs, which will be a positive because it kind of plugs the gap between the interest income as well as dividend income. Because earlier, for certain HNIs who had holding companies, the interest income was more favorable. So basically, REITs, and there are many REITs which are yet to be listed. So I think that kind of will find favor in a lot of ultra HNI portfolios going
So,
forward.
so this is any dividend that is being paid by a REIT or an InVEIT to
Yeah,
the unit holders or to the investors.
correct.
Now there is
Correct.
no TDS on that.
That's right. That's right.
Okay, so there is some relief coming in for those who, of course, use those forms of investment. But I just
Right.
want to come back to the ULIP part because I think for a lot of retail investors, a lot of the viewers and people who joined us on this chat on digital, that's going to be the big one, Preeti. So go over this once again before we could connect with you. I was just discussing this with Ashish. The annexure now tells us that if your ULIP annual premium is above 2.5 lakh rupees, then it no longer enjoys that ATC advantage. Is that so? Then there is going to be an element of perhaps capital gains taxation as well.
Right. So frankly, I need to look at the fine print, but what it appears is that if your annual premium contributions are beyond a monetary threshold. So earlier there was no monetary threshold. It just said that your contributions to ULIP, which have to a life insurance or any kind of policy where there is life insurance exceeds that 10% cap, then of the total sum assured. In that situation, there were certain exemptions which were available, but now what it appears is that there is also a monetary cap to that. So you need to watch out for how much you're paying, as premium. But what I really need to see now is that only the premium contribution, or are we looking at the total amount that you paid towards the ULIP? I think that's going to be part of the fine print. So yeah, I need to see that.
Yeah, yeah. Ashish, you want to comment on this? I mean, is this meaningfully going to change the way people are looking at their allocations? Because ULIPs have become a pretty efficient route. I mean, they didn't have the 10% long-term capital gains taxation that mutual funds did. And I remember doing a number of these studies, and over a 10-year period, I mean, a ULIP was actually turning out to be slightly more tax efficient just because there was no incidence of capital gains tax on it.
Yes, so a lot of ULIPs were being sold as more tax efficient than mutual funds. Of course, both products are very different because here you also have some mortality charges and some administrative charges, but it just brings both on the same field. And I do believe that for investments, mutual funds will become a more preferred vehicle going forward. Second, I mean, insurance as an industry will still continue to grow because a lot of insurance also gets sold by way of traditional plans. I mean, ideally, people should buy insurance for protection, but I know there are a lot of investors out there who just like the comfort of guaranteed returns. And traditional plans can guarantee returns, unlike any other, financial investment. So definitely, I think ULIPs, that benefit of, taxation, that edge over mutual fund goes away. So people will think twice before, allocating their investment funds to ULIP is what I feel.
You think it'll have any market sentiment impact, Ashish? Because on one hand, of course, the insurance sector has got a big boost. The FDI limit has been hiked to 74. On the other hand, you have this clincher in the form of the taxation element itself in one of their products.
Not really. I don't think there should be too much of an impact on market sentiment because see, the margins on traditional plans have always been much, much higher than the ULIPs. So from a profitability point of view, insurance companies are not going to impact it. And on the FDI bit, I just wanted to add that, this is still a proposal. It needs to be passed in the parliament. And I know that, there are a lot of people who are opposed to this. So I think the real test is once this bill gets introduced on the floor of the House.
Of course, that we'll have to see. But yeah, let's broaden this out, Preeti. You tell us, when we've discussed the ULIP bit, which is very important, and of course, the 2.5 lakh rupees of a cap on the PF interest as well. Anything else major that you were watching out for? What kind of stands out?
I think what is really interesting is what they've done on dividend income. So, they've said that if you've earned any dividend incomes, then the advanced tax compliance will only begin after declaration. Now, there's a slight catch there, because within 5 days of declaration, the company is supposed to release the dividend to you, so it has to be paid to you. But as an individual taxpayer, if you're holding shares of companies that pay dividends, then it's really difficult, and it's 100% taxable for you. So for you to be able to keep track of your advanced tax compliance, I think that's even more complicated. So this is not really a relief. It's a tax law that has come because dividends have become taxable. So earlier, the hands of individuals, in the hands of shareholders, and now that they become taxable, advanced tax compliance begins from the time the dividend is declared. Now, if you put it in practical, situation as a shareholder, I need to watch out for when that dividend has gotten declared, so that I can include it in my advanced tax calculation. Now, if you are holding shares of companies that pay large dividends, unfortunately, this is going to be a difficult exercise for you to make sure. So you will end up, seeing some tax due, which is always a pain. Under Section 234C, there's a 1% penalty per month on non-compliance with advanced tax. What it means is that, say, if you were paid a certain dividend, say, for example, in the month of December, so whenever you're making that quarterly tax payment for that particular quarter, you should have included that dividend payout. Now, as an individual taxpayer, I would have preferred where the government would say whatever dividend income you have earned, which is, say, beyond a certain threshold, beyond 1 lakh or 2 lakhs or 3 lakhs or whatever, you don't have to comply with advanced tax at all. Because, say, if I have only salary income and interest income, which faces TDS, salary income faces TDS. Now, dividend income does not face TDS, and therefore give me some relief on that, or else, remove this clause of declaration. Whatever dividend income has been earned, say, by the time it's 15th March or 31st March, is when I should be allowed to pay tax on it. So yeah, I feel that one provision there, there's definitely something that could have been done extra, that they could have avoided, that they completely remove that advanced tax requirement for dividends for individual taxpayers. Surbhi, we can't hear you.
Yeah, okay. I'm saying now we just have to be a little more alert, because many people, myself included, sometimes forget our advanced tax calculations on interest income, and now you have to think about dividends as well if you're getting any. But on the subject of dividends, Preeti, just a clarification, mutual funds do cut a TDS above a threshold. I don't think there's been any change in that regime at all, right? So even mutual fund investors, if at all they're still in the dividend option, they will still have to sort of account for that.
That's right. So there is no new tax or no new TDS that I came across. There have been a couple of changes in Section 191 and 4 and stuff like that. Those are all TDS sections, so need to go through that in depth. But so far, as what I've seen, there doesn't seem to be any change with respect to TDS on dividend income, except for this advanced tax, which comes more as a regulation than as any kind of relief.
Okay. Ashish, I was just also looking at the way the markets reacted to this, and we've got this roaring rally going on, right? And it tells us we're in a different world. Any other time, if the government had exceeded its fiscal deficit targets by such a huge mile, we would have had a near crash. But today the market is celebrating the fact that the government is going to go out and perhaps spend its way out of this crisis. So your thoughts on just the overall take and what the common investor and the common salary earner should keep in mind?
Yeah, see the fiscal deficit number at 9.5. One needs to look at the fine print. What I understand is that the loans to Food Corporation of India have also been brought on the main balance sheet of the government, and that is why there is a spike. So that exact amount we'll need to see from the fine print. But yes, all in all, it's heartening to see that the government is focusing on growth. They have significantly improved or increased their capital expenditure on multiple items like railways, roads, infrastructure. So it's an expansionary budget in that sense. So there may be some dent on consumption in the near term, and there's a big boost to infrastructure. I think the government did the right thing. This is the right time to do this, as most other economies are also in an expansionary mode. So even the rating agencies will probably ignore this year as a one-off, and will really want to see how the trajectory of fiscal deficit pans out. See the real risk, if you ask me, Surbi, is in the GDP figures that they've assumed, and as a result, the tax collections. They are assuming a real GDP growth of around 11.5%, and if you say inflation of 3-4% on top of it, you're talking about nominal GDP growth of 15%. So that's where the risk lies. If there is, if the growth, which is right now V-shaped, the recovery, if there is some interruption in that, and you have some other challenges going forward, that is when I will start worrying. But otherwise, it's I think a very growth-oriented budget. Government has done the right thing. No serious negatives, in the tax proposals. So all in all, I think very good. I'm happy.
Okay. And Preeti, in your final verdict on the budget, also, I think the market's so happy. At least there's no change in short-term capital gains, long-term capital gains, and STT, unless you've seen something in those documents. That was a big, big worry, right? That's why the sell-off was happening as we were going into the event. So you tell us your final verdict.
I think when you keep your expectations really low, then it's easier to sort of meet them. And that's what the finance minister did. We all had we didn't expect much. We were not asking for a lot of tax relief. We were worried about more taxes. So that has not happened. Of course, there is some fine print, and others. If you look at across the world, if you look at whatever tax changes have come up for individuals in various economies, you will see that most economies are moving towards taxing the wealthy, taxing the super rich, and in some form or the other that has to come through. So you see whatever is unsustainable, something like giving out PF interests, those are getting now captured. So, and compliance becoming easy for businesses, I think that is the complete focus of this government, and that's very, very good for the economy, because with there's certain changes which have come through for small businesses in terms of tax audit relief, and also for small private companies where the turnover thresholds have been increased, the paid up capital thresholds have been increased. Now, if you are someone who runs a business, you do 4 board meetings in a year, you have to do certain compliances with the Companies Act, and those get reduced if you fall under the definition of a small private company where these enhanced turnovers come into play. So I think in that sense, there's definitely relief on compliance that will be greatly welcome. With GST, compliance has gone up many-fold for businesses. So this is definitely a good move. And I feel like with reduced corporate tax rates and reduced compliance for companies, you will see the impact on growth. You will see the impact on stock markets, because stock markets love it when there are no reduced taxes on corporates, and then reduced compliance for corporates. That converts to shareholder wealth, that converts to wealth generation for people who invest through mutual funds, who invest through equity investments. And definitely I feel that that kind of a cyclical impact will be good for the economy. So yes, fingers crossed, no more new taxes. Hopefully the Prime Minister was mentioning that there are going to be many budgets which will keep coming like last year. So I'm hoping there is no another economic package coming through, but otherwise, yeah, good to go for the next financial year.
Okay, so a sense of relief is what prevails over this panel. I think that's the best way to sum it up. Thank you very much, Preeti and Ashish, for joining in and giving us your first impressions of Budget 2021. Thanks very much.
Thanks, Pleasure.